On May 14, 2026, Dartmouth College filed a Form 13F with the Securities and Exchange Commission, disclosing that its roughly $9 billion endowment holds approximately $14 million in cryptocurrency ETFs, $7.7 million in BlackRock's iShares Bitcoin Trust, $3.5 million in the Grayscale Ethereum Staking ETF, and $3.3 million in the Bitwise Solana Staking ETF. You probably read that headline and thought, so what? A university put $14 million into crypto. In the context of a $9 billion endowment, that is 0.15%. That is a rounding error. That is the kind of number that gets filed and forgotten. You would be wrong to forget it. Not because of the size, because of what the size tells you about the process that produced it. A university endowment is not a savings account. It is not a hedge fund making aggressive bets. It is one of the most conservative, most scrutinized, most compliance-heavy investment structures in the world. The people managing these funds are called fiduciaries. That word has a legal meaning. A fiduciary is legally obligated to act in the best interest of the beneficiary. A fiduciary who makes a reckless investment decision can be personally liable. These are not people who make impulsive bets. When a university endowment buys Bitcoin through a regulated ETF, it is not making a speculative bet. It is completing a due diligence process that most retail investors will never see and never fully understand. They ran scenario analysis across multiple market regimes: bull markets, bear markets, correlation breakdowns, liquidity crises. They modeled the impact of a small Bitcoin allocation on the portfolio's overall Sharpe ratio, the measure of return per unit of risk. They presented to a committee. The committee asked questions, hard ones. They came back with answers. The committee approved a small exploratory allocation. That process takes months, sometimes years. The investment committee of an Ivy League endowment does not move quickly. When it moves, it has already seen everything you have not. Digital asset investments, along with AI bets, appear to have enhanced the already strong performance of top universities by as much as 200 to 300 basis points. Among the most impressive overall performers were Michigan, with a 15.5% annual return, MIT with 14.8%, and Stanford at 14.3%. 200 to 300 basis points of additional return? That is not a rounding error. That is the difference between a portfolio that keeps pace and a portfolio that compounds. Dartmouth is not alone. It is not even close to the largest. Harvard increased its stake in BlackRock's iShares Bitcoin Trust to nearly 7 million shares, a 257% increase, valued at $442.8 million. Bloomberg ETF analyst Eric Balkunis noted the rarity of top-tier endowments purchasing ETFs, calling it as good a validation as an ETF can get. Harvard's $443 million Bitcoin ETF position is its largest declared public equity holding, larger than its Microsoft position, larger than its Amazon position, larger than its NVIDIA position. The largest university endowment in the world made Bitcoin its single largest publicly declared holding. The State of Wisconsin Investment Board holds over 6 million shares of BlackRock's iShares Bitcoin Trust, worth approximately $387.3 million, one of the largest state pension allocations to Bitcoin-linked products. The State of Michigan Retirement System tripled its Bitcoin ETF holdings to 300,000 shares, valued at $11.4 million. Other universities reportedly investing directly in cryptocurrencies through exchanges include Brown, Yale, Harvard, and Michigan. In all, there are at least a dozen universities making strategic bets on digital assets. Brown University reported shares valued at $13.8 million. Emory University reported a $52 million stake in the Grayscale Bitcoin Mini Trust. At least a dozen universities, all making the same quiet move. The ETF structure matters enormously to institutional investors. A pension fund or endowment cannot simply open a Coinbase account and buy Bitcoin directly. The custody requirements, the accounting treatment, the compliance documentation, the counterparty risk assessment, the operational complexity of direct cryptocurrency ownership is prohibitive for most institutions. A Bitcoin ETF is different. It trades on a regulated exchange. It has an audited NAV. It files with the SEC. It can be held in the same custodian accounts that hold stocks and bonds. The compliance department knows how to handle it. The auditors know how to account for it. The board knows how to approve it. The ETF was the key that unlocked the institutional door. And the door is now open. Bitwise analyst Ryan Rasmussen predicted that Harvard's 0.75% allocation will grow to 1% and eventually 5% as peer institutions follow suit. Harvard is one institution. There are at least a dozen universities currently allocating. There are 50 state pension funds. There are sovereign wealth funds. There are corporate treasuries. BlackRock now owns more Bitcoin than any other entity in the world, more than $75 billion, with the notable exception of Bitcoin creator Satoshi Nakamoto. They are not buying because they are excited about technology. They are buying because their models tell them a small allocation improves portfolio efficiency. They are buying because the ETF structure removed the operational barriers that previously made it impossible. They are buying because their peers are buying, and fiduciaries watch what other fiduciaries do. And they are buying quietly, not on crypto Twitter, not with press releases. In 13F filings submitted to the SEC on quarterly reporting deadlines that most people never read. Dartmouth noticed, then Harvard, then Wisconsin, then Michigan, then a dozen more. That is what they know that you don't. Not a secret about Bitcoin's price. Not a prediction about where crypto goes next. They know that a small allocation to an uncorrelated, volatile asset, even one they are deeply uncertain about, can improve a portfolio's risk-adjusted returns in ways that traditional allocations cannot. They know this because they ran the model. They presented to the committee. The committee approved it. And then they filed quietly with the SEC and waited for someone to notice. The question is not whether the institutions know something you don't.
DeFi 2026, from meme coins to real yield. No fluff, no hype, just a clear breakdown of how people are actually generating passive income in DeFi right now. How to avoid the traps, how to spot real opportunities, and how to build something that actually lasts. And here's the part most people overlook. You don't just learn this, you can earn from it too. Every time someone buys through your link, you earn 30% commission. And for the first 50 people, there's something extra. One person walks away with a hardware wallet. And if you're serious about protecting your assets, you can grab your own offline wallet through the link below. Because 2026, it's not about meme coins anymore. It's about real yield. Link in the description.